Hi there YouTube, it is Monday the 25th of September, and that means it's time to take a look at what moved the markets last week. Going into September, through much of August, I said that markets were probably going to take a bit of a breather. August itself wasn't a fantastic month for markets, but we didn't get that pullback in indices and stocks that I had been expecting. But now, here we are, and here we have it. So the September effect refers to the fact that going back for a century, September is on average the worst month for equities. There actually isn't any strong causal link with any events that happen through September that cause this effect to happen, but on average it does happen, and this year September seems to be no different. If we look at a map of the S&P 500, these are the movements of the 500 stocks in the S&P 500. You can see that a large part of the S&P 500 constituents are red for the month. Of course, there are some patches of green. When you look over a month's timeline, there will almost certainly be some companies that have done well. But if we look at the performance of the index, and it's the bottom one here, we can see that since the end of August, the S&P 500 is down nearly 4.5%, while the NASDAQ 100 over the same time frame is down over 5%. Now, if we put the September effect to one side, I do think that it makes sense that markets have pulled back. First of all, we have the price of oil that's been on the rise and has spooked market participants, because an increase in the price of oil means that the price of energy, all kinds of energy, are going to increase, and any good or service that uses energy, which is just about everything, is also going to increase. Long story short, a rise in the price of energy means that inflation could be high for longer. In addition to this, last week we did hear from the Fed, and they held rates steady, which was as expected, but they've also said that there is probably going to be one more 25 basis point hike through this year, which spooked markets a little bit. But the fact that the Fed is pointing to another rate hike through this year wasn't the only thing that scared market participants. They also broadcast an opinion that interest rates are going to be higher for longer, and they did this through the dot plot. The dot plot shows how the members of the Fed think they will vote on rate hikes or cuts in the future. And through each of the recent Fed meetings, the number of people thinking that rates are going to be higher for longer has increased. And so we've got oil prices rising, which might make inflation stickier. We've got the Fed being quite hawkish about rates, not only in the short term, but also in the medium term. We've got a stock market where many of the participants in the stock market are incredibly overvalued, especially because the share prices of those companies have risen on the assumption that growth is going to continue into the near-term future. The problem with that assumption is that there is a lot going on right now that looks as though it will slow down growth significantly over the next few months. So this translates into a market that is quite fearful at the moment, and has good reason to be so. However, I would prefer the market to be fearful than to be extremely greedy, because when you have irrational extreme greed in the market, that's when you see the very large collapses in stock prices. Just to quickly touch on what was going on outside of the US, well, the CPI number, consumer inflation in the EU, came in slightly lower than expected. Good news there. Within the UK, inflation came in quite a lot lighter than was expected. And this translated into the UK's central bank, the Bank of England, holding rates steady, which is the opposite of what people had expected going into last week. You can see that the forecast was for an increase. I wanted to quickly touch on some news that was important to stocks in my portfolio. So studios and writers in the US have reached a tentative agreement to end a strike. There's been a strike going on since May in the US. And the impact of the strike is that for a very long time, a lot less content has been produced. So for those businesses who make their money by broadcasting movies and series, there's going to be an impact to their top and bottom lines. Companies in my portfolio that will be impacted by this, by the strike, and also by the end of the strike are Amazon with its Prime Video service, Disney with its Disney Plus streaming service, and Warner Bros. Discovery with its plethora of media services. While we're on the topic of those three companies, I also did want to highlight how much ad budgets are moving to Amazon. Amazon is becoming this enormous ad tech business. And if you don't want to believe what the media is putting out there, just go take a look at their last earnings report. They're making a hell of a lot of money through advertising. The reason that so much money is going towards Amazon is because they have buyers with very strong intent and they are very well segmented. What do these phrases mean? Well, from Amazon's perspective and those people that advertise with them, they have information that knows what you want to buy and that you are going to buy something within that category. And so they know more or less the exact things to serve you up in terms of ads. Because of this, Amazon is able to charge a much higher premium on its advertising services. As a counterexample, you can imagine that if you are a person on Facebook or you're Googling around, you're not necessarily looking for something to buy. So the ad service might serve up an advert that has absolutely no chance of converting into a sale because you are not trying to buy that thing or you're not trying to buy it at that moment in time. I did also want to touch again on Walt Disney Company. I've been talking about this quite a lot over the past few weeks and months, and that's because the stock is just so damn cheap. The stock price right now is close to what it was at in 2014, and there is a good reason for this. They had a very tough time through the pandemic. Their parks closed entirely, their cruises closed entirely. A large part of their revenue streams were just shut down, and this is reflected in their revenue numbers and their profitability through the past few years. The company was also forced to take on more debt as part of getting through that rough patch that the coronavirus created. However, they are most certainly climbing out of that rough patch. Revenues now are hitting record levels. The thing that investors are waiting to see, though, is profitability rise to levels and beyond where it was going into the pandemic. The reason that I think it is an incredibly promising stock, well, you can see that earnings growth has been headed in the right direction and has been very strong recently. The fact that they brought Bob Iger, the man that made Walt Disney, into the company, it has been for the past 20 years. They've brought him back as CEO. And of course, these revenue numbers are incredibly strong. This is not a fly-by-night company. They know how to turn a profit. They're busy climbing out of an ugly hole that they were forced into. So I think it's just a matter of time before profitability catches up to where it was before. And then Warner Brothers is the last company in this trio that I mentioned earlier. Warner Brothers Discovery being the company that was created by the merger of Discovery and Warner Brothers. AT&T wanted to focus their business, so they were looking to get rid of Warner Brothers, and so that created this merger. However, as part of this deal, the merged entity took on a hell of a lot of debt from AT&T. It's very difficult to go back and look at historical numbers because before this merger, Discovery was an entirely different company. And it's very easy to see this. For example, you can see that in 2021, their revenue was $12 billion, and then the next year it jumped by over $20 billion because of the merger and the revenue that came with it. If you look at the share price, you can see that it spiked sharply, nearly all the way up to $80 a share, and then has been dropping just about ever since. And at the moment, it is sitting at a multi-year low, in part because of these strikes that have been going on. The reason that investors have shunned Warner Brothers Discovery is because of the enormous amount of debt that it has taken on. And it's going to take them years to eat through that debt pile. What I love about this company is the breadth of resources that it owns. I mean, there are so many networks that Warner Brothers Discovery has complete ownership of. They're not just making movies, they're making fictional series, and there's a lot of non-fiction in their library too, of course, from Discovery. But the proof is in the pudding. They've got a huge debt pile to eat through. How have they been doing so far? Well, this information is very easy to get access to. We can see that it's reduced its debt by approximately $10.9 billion. So the mountain is slightly smaller, but is still $42.5 billion. By the end of next year, they're expected to bring that down by another $9 billion. And this would be well ahead of the scheduled maturity dates for that debt. In other words, they've taken loans out for a period of time. They're going to be able to pay those loans off before they become due. At some point in the next few years, after they've eaten through enough debt, they'll be able to slow down how much profit they'll pour into paying that debt down. And once that happens, I think that this stock is going to go through the roof. I think looking back over a 5 to 10 year horizon, this is going to end up being a multi-bagger. They've got a huge number of incredibly valuable assets. They've shown that they can run the company in a way such that they can pay down their debt ahead of schedule. And the combined entity is just a media powerhouse. So what can we look forward to this week? Well, there are GDP numbers out of a few key geographies. We'll get that GDP number out of the US on Thursday, the UK on Friday. And whilst these numbers are important for investors, I think that the core PCE number will be the thing that has the most potential to move the market. This is a measure of inflation that is preferred by the Fed. So if there are any surprises here, it could cause the US Fed to change tack. All right, that's for this week. I hope you have a good one. Speak to you soon. Goodbye.